Nobody looks at a $5 bill and thinks it can replace their salary. Because of that, most people never start investing. We assume wealth requires a massive inheritance, a lucky stock pick, or a six-figure income to even get off the ground. The reality is that people don't fail because they lack money. They fail because they log into a brokerage account, see thousands of exchange-traded funds, get overwhelmed, and buy a basket of stocks that completely contradicts their actual life stage. To fix that, we look at the investor's trilemma. You control three variables: time, capital, and concentration. Cut your timeline short and you must aggressively increase your cash inputs or take on highly concentrated risk to compensate. This forces you to make a definitive choice about what your money needs to do. You can optimize a portfolio to grow a massive overall account balance over decades, or you can optimize it to hand you a reliable, usable cash paycheck every single month. You cannot efficiently do both at the same time. There is no universal best ETF. A fund perfectly securing a 60-year-old's retirement will mathematically stall a 20-year-old's growth. Success comes down to pulling the correct lever for your exact financial reality. Let's start with the time-rich demographic. If you are in your 20s or 30s, you might only have $5 or $10 a day to spare, but you have something much more valuable: decades of uninterrupted runway. For this group, the foundational tool is a broad market index fund, like VOO or VTI. The structure was pioneered by Jack Bogle to track the entire US economy. Instead of betting on individual winners, you buy a microscopic fraction of the 500 largest companies in America, all at once. This chart tracks 30 years of investing roughly $6 a day. Down at the very bottom, this thin baseline layer represents your actual out-of-pocket contributions. Over 3 decades, you contribute about $65,000. But here is what the long runway provides. Because the dividends reinvest and compound, the market does 90% of the heavy lifting. Your $65,000 serves as the seed for roughly $938,000 in pure market growth. The trade-off for that growth is entirely psychological. Over 30 years, the market will crash. You will see red numbers. To get the $1 million result, you have to possess the emotional endurance to hold your shares when the headlines tell you to panic. There is also a structural trade-off. Broad market funds are designed to grow share price, not to pay you. A $350,000 balance in an S&P 500 fund might only yield $40 a month in usable income. If you have decades ahead of you, time acts as your greatest shield. You do not have to sacrifice a large portion of your current paycheck to reach your target, as long as you can accept that the wealth stays on paper until you finally retire. Now, consider the time-poor demographic. These are mid-career investors, starting from zero in their 40s or 50s, who realize they need to retire in exactly 10 years. The math here is rigid. Safe, broad market index funds require time to compound. You cannot put $5 a day into the S&P 500 and reach $1 million in a single decade. The math simply does not support it. To reach that $1 million target in 10 years, you have to aggressively pull the other two levers in the trilemma. You must inject massive daily capital, roughly $120 a day, and you have to move your money into hyper-concentrated sector ETFs, like QQQ or VGT. This table exposes the exact cost of losing time. In a 30-year timeline, the market gets you $14 for every single dollar you invest. On a 10-year timeline, the market only has time to give you $1.50 for every dollar you invest. To even get that return, you have to rely on sector concentration. Instead of buying the whole economy, you are placing a massive targeted bet on a handful of technology and semiconductor giants. You are artificially forcing the portfolio to accelerate. This introduces extreme vulnerability. Technology sectors are volatile. If you are entirely concentrated in semiconductors and the industry pulls back by 30% during your 10th year, your retirement date vanishes. You can buy back lost time, but the bill is steep. You are paying for the compounding you missed out of your own paycheck, and you are carrying a dangerous amount of sector risk right up to the finish line. Finally, we have the capital-rich or yield-hungry demographic. These are investors nearing retirement, or people sitting on a lump sum who need immediate, reliable cash to pay their bills today. If you try to live off a growth portfolio, you face sequence of returns risk. When the market drops and you need cash for groceries, you are forced to sell your shares at a loss. You permanently cannibalize the very engine that builds your wealth. To stop that from happening, you transition away from growth and move into income engine ETFs like SCHD or JEPI. These funds are screened specifically to hold companies that consistently pay out large cash dividends. This graph illustrates how an income fund operates. The blue line, representing your total account balance, grows very slowly, but the green line, representing your monthly dividend yield, climbs steadily. You get a monthly paycheck directly from company profits without ever being forced to liquidate your actual shares. But look at the top of the chart. Choosing income means intentionally accepting a hard ceiling on your net worth. Companies that pay out heavy dividends are not reinvesting that cash into aggressive expansion, meaning the share price stays relatively flat. You purposefully stunt your total account size in exchange for a permanent paycheck. It eliminates the fear of a market crash ruining your retirement because your share count stays completely intact, continuing to pay you regardless of the share price. Building a portfolio isn't a search for the single highest returning fund. It is a process of systematically eliminating the strategies that actively conflict with your life constraints. This flowchart maps out exactly how to apply the trilemma. At the very top, we sort by your primary constraint. Do you have decades ahead of you, or are you short on time and heavy on capital? If you are time-rich, follow the left branch. Your goal is maximum growth without requiring a high salary. You anchor your money in broad market ETFs like VOO or VTI, and you let the compounding engine run uninterrupted for 30 years. If your constraint is a short timeline, the map forces you down this path. You must accept aggressive daily inputs and concentrate your risk into tech-heavy growth funds like QQQ or VGT to bridge the gap. And if your goal is usable monthly cash flow to replace a salary, you drop down the final branch. You abandon the pursuit of massive account growth, and you lock into yield-focused funds like SCHD or JEPI. Aligning your money with this map prevents the #1 cause of ruined portfolios. You never want to find yourself applying a highly aggressive, short-term strategy to a 30-year retirement plan. We started by addressing the capital myth, the idea that small amounts of money are too insignificant to matter. The math proves the exact opposite. Putting $5 a day into an index fund starting right now is mathematically superior to attempting to save a massive lump sum and investing it 10 years from today. The market doesn't care if you input $5 or $5,000. The gears of compounding function identically as long as money enters the system. Decide what your timeline is. Determine your exact target number. Turn on automatic dividend reinvestment, and then step entirely out of the way. The greatest threat to your financial future isn't a stock market crash, and it isn't picking an ETF with a slightly lower yield. The greatest threat is looking at $5 a day, deciding it isn't enough, and choosing to walk away from the math entirely.